Welcome back with stocks at record highs. What is the best way to play the markets into the second half? Let's ask 3Fourteen Research's Warren Pies. It's good to see you. What's the first thing that comes to your mind? I mean, I feel like the market doesn't have a care in the world until it does. But today, even with a little bit of a pullback off of a trade headline from the White House, doesn't seem to be doing all that much.
Yeah, thank you for having me. I mean, it's easy to say that on a day like this, but we've built quite a wall of worry, I think. So we've been telling our clients to stay bullish. We look out at the second half, and I think the first half was really defined by a bunch of events. And 1 week we're thinking about tariffs, the next week we're thinking about going to war with Iran potentially, and it's really, I think, created this wall of worry, all these events. But when we zoom out and look at the market and think and ask ourselves, where have we come from the beginning of the year? We've basically consolidated when you take all that stuff away for a minute. Forward earnings are at an all-time high, which is unequivocally positive for the market. And what we've had is a sentiment reset. So we came into the year with the 6,800 target on the S&P 500. Our big concern was sentiment. We thought we needed a 10% correction in the first half to reset sentiment. And we see that now. Strategists have dialed down their targets, and I think we're clear sailing, at least as much as you can be in these markets for the second half.
Are better earnings than expected? Is that what at the end of the day will define the second half in the market? And in some respects, it has to, correct?
Yeah, I mean, I think that's the bet, right? We've brought estimates down a bit. I think there's some concern around tariffs and how those tariffs flow into earnings, and I think it's actually given us, oddly enough, kind of a lower bar for the S&P to jump over. So, yeah, I think earnings should be okay. I mean, our biggest risk, and we listed all the risks in our H2 outlook for clients, is really the economy, which obviously indirectly you're not going to grow earnings if the economy falls into recession. And so that's where we're focusing most of our attention. But for now, I think we're in the same kind of muddle through soft landing environment, and I think S&P earnings are going to surprise to the upside.
So what does the playbook look like then, if we believe what you say and it actually comes to fruition? Where do I get the most out of that?
Yeah, I mean, I think we're going to stick with high quality stocks. So one of the things that we've noticed, if you're going to pick nits in the market right now, breadth is kind of weak. So we've got the market at an all-time high. The median stock within the market is still like 13% off a 52-week high. We did a bunch of analysis on that. That's odd historically. But what we found is that that's really happened a number of times in this bull market because we have this mega cap led bull market. So if we're going to advance to this, like another 10% in the second half or something like that, you've got to get participation outside of just this very narrow mega cap world. And I don't think, I'm not talking small caps or mid caps. I'm just saying within the S&P 500. So I like high quality still. I think we're going to broaden out a little bit. Still going to be mega cap led. I think I do think oil is going to be weak in the second half. That should be a tailwind in the market, but you want to stay away from some cyclical commodity producing stocks. And I think bonds are going to be okay. I think that the consensus was so concerned about bonds coming into the year, and this is something you and I have talked about over the months. Mm-hmm. And our view is that rates were going to fall. And so I think that's a kind of a nice mix for assets in general. Don't go crazy getting low on the quality spectrum, though.
But it's interesting because people are doing just that. And whether it's you or others who consistently come on the network and say high quality, stick to the better, the biggest. If you look at the high beta stocks, the high beta ETF, for example, and lower quality names, they're doing incredibly well. What's the message or the risk in that?
Well, a part of that is normal off of a market low. Beta is like the number one factor when you make, and we put in a pretty significant low. When we look back at this, when it was a fast rebound, but we were down almost 20%, basically a bear market. So, traditionally, as much as it feels weird, traditionally, this is what you would expect to see high beta lead. I think the next stage of the bull market kind of by definition has to broaden away from that group, though. And so if you ask me how to rotate your portfolio, I think some of these underperforming quality names that have been kind of forgotten about in this crazy speculative run, that's where we're going to get the most bang for our buck, the best risk-adjusted second half return.
Because some say it's classic late cycle FOMO moment when you see that performance from lower quality, higher beta.
Yeah, I mean, to me, I would push back against that a little bit. When we study cycles and factor performance, actually low quality leads off market lows, and we had a market low. I think this is part of that wall of worries that you have a pretty big consensus that doesn't recognize the event that we just went through. We went through a real important clearing event where we came in over optimistic. Maybe I think more of what we saw around the peak in November, where we had small caps, people were trying to buy small caps and stuff like that after the election. That looked like toppy behavior to me. And now what we've had is a washout, and no one wants to believe what's happening. But in fact, I think this high beta leadership is a little bit like what you'd see off of a major market low. And so that tells me that we're still, as crazy as it sounds, like maybe in mid innings for this ongoing bull market.
Wow. All right. We'll leave it there. Warren, thanks. We'll see you soon.